Good afternoon. How's everyone doing? It's Friday afternoon, March 4th. We are cooking already in 2022. I'd like to welcome you. This is Wall Street X's and O's. My name is Craig Modelmog with Cornerstone Wealth Management. I'd like to welcome everyone. I know I have a few regulars, 2 or 3, maybe 4 on a good week. For those of you that may be new, this show is uncut and unedited. As I say, I'm like John Daly. I grip it and rip it. If you don't know who he is, look him up. He hit the crap out of the golf ball, and he never knew where it went, but he made a lot of money, and you know what? Good for John. But, this show's, number one, it's kind of fun. It's really geared towards trying to educate you, first of all, on becoming a better investor. But secondarily, or kind of a secondary focus, is really to start to pinpoint some of those things that are really flying under the radar when it comes to the news, whether it be watching it on TV, CNBC, local news, what you read, what we hear. You know what? I'm often amazed at how much information comes out and how the narratives get spun to slant one direction or the other. I try to be very transparent. I call a spade, and without further ado, we're going to get rolling here. But first things first, we have the legal component, because we have to, I have to, from a compliance and regulatory standpoint. So without blabbing any longer on that, I'm going to get going here. The content that's presented on this show is for informational purposes only. None of the information contained herein constitute an offer to sell or a solicitation of an offer to buy any type of security or investment vehicle. It does not constitute an investment recommendation, legal advice, tax advice, really any advice, okay? This information is presented without regard for an individual's investment preferences or risk parameters in general. It's basically non-tailored and non-specific. Investments can and will lose money. They are not FDIC insured. And now we're going to get rolling. Good Lord. I hate that thing gives me cotton mouth every time I have to say it. I don't know why. It's just the way it is. But anyway, top 3 things today. Oil as a recession indicator. Yeah, we're just getting to it today. All right. Markets have been nuts for since the start of the year, honestly. And they continue to be nuts, and that's both the stock and bond market and commodities. It's been just a treat, let me tell you. Top 3 things. Number 2 on the board is the Fed's role in those recessionary periods. I'm also going to hit on the yield curve, really review what it's saying today, and really what I'm anticipating happening based on the current data. And then I'm going to close out, as I always do, with things that make you go, Anyway, number 1, oil as a recession indicator. There have been 12, as I choke on my spit, that's awesome, isn't it? There have been 12 recessions since 1946. Guess how many of them have occurred immediately following a substantial or just a moderate rise in oil prices? I'm going to let you think about that for about 10 seconds. Go. When it's quiet, it kills you, doesn't it? There's 10 seconds. Okay, here's the story. 8 have followed major oil price shocks like we're having now, while 3 have occurred immediately following a more modest but still notable price run-ups. Okay, let's count. 8 plus 3 is what? 11. We're talking about 12 total. So, see, and you can see this is uncut because my phone is ringing. I should have hit my do not disturb button. I'm going to remember that next time, although this kind of adds some flair to it. Anyway, back at it here. Where was I? 8 plus 3 is 11. We're tracking the last 12 since 1946, okay? That only leaves 1 that doesn't have oily fingerprints all over the crime scene, okay? If I am being Mr. Crime Solver, I was trying to think of a notable crime solver, and all I can think of is the Pink Panther, Inspector Clouseau. It's Friday. I am stretching. If you don't know who Inspector Clouseau is, dang it. You guys don't know some good comedy when you see it. Is it correlation? Is it just causation? Perhaps, but yeah, I tell you what, 11 out of 12 is one heck of a coincidence. Okay, that's pretty incredible. Moving on. One would then argue, say, well, Craig, the Fed's role in the same recessionary periods. Well, it's true there were other significant events during those recessions, which is true, like the Great Financial Crisis, that was a big one. The pandemic recently, another big one, and the dot-com bust, which was 2001 and 2. What it seems is there are other catalysts that are associated normally when this happens. But let's kind of drill into really the Fed's role in these particular recessionary instances. Okay, we only have data going back to 1954 because that's just as far as it goes back. Why? I really don't know. I didn't research that part. Maybe one of you could do that and let me know why it only goes back to 1954, but it does. So that means we're only looking at 10 recessions. Okay, of those 10, guess how many were preceded by an increase in short-term rates? I'm not going to wait 10 seconds because that kills me probably as much as it kills you. Here's what's amazing, all 10. Okay, what I find interesting is that the Fed's policy tends to follow a very predictable or reoccurring pattern. Okay, they start out as step one, they're way too easy, mean easy cash, which is going to give cash to everyone, does not work. Okay, step two then begets energy inflation like we have now, which then creeps into the broader headline of inflation like we have now, and then it continues to move towards a prick of the energy bubble that's been created, and in doing so, that has happened 10 out of 10 times. That's crazy when you think about it. So there's lots of things going on right now that have led me to become more defensive in how we are allocated, which should this continue or persist and the data begin to pick up a velocity, which another term for that from a mathematical standpoint is rate of change. How quickly does something change, as we've talked about from one show to the next. And as that velocity picks up, you know what? It's probably going to lead me to be even more defensive. So, sit tight and we're going to wait and see what happens, okay? Top three things. Number 3, yield curve. What is it saying right now? Well, right now it's been flattening. What does that mean, Craig? You hear yield curve a lot. Well, when you go out and purchase a bond, the sooner that it matures, say you're going to buy a 1-year treasury bill or a 5-year treasury note or a 30-year treasury bond, each different tranche, or when it matures, 1 year, 3 years, 5 years, 15 years, 20 years, 30 years, the further out you go from the expiration date of the actual bond, the higher the yield is typically. And I say typically because that's going to lead into what I'm talking about here. Typically, the further out on the yield curve you go, the higher the interest rate. Why? Well, if you're going to lend your money to the U.S. government or a corporation, in return, you receive an interest rate. That is called your payment or your coupon, okay? The longer that bond is, the perceived more risk there is, thus the higher interest rate. Follow me? So you usually see this, and one of these days I'm going to use a real cool tool. My daughter's coming home in about a week for spring break, and I'm going to help her teach me how to use this tool because I'd like to be able to draw on my screen. I can do Zoom meetings now and Teams meetings now where I can draw on my screens, and it's the coolest thing on the planet. I haven't figured out how to do this on this cheap-ass recording thing that's on Microsoft's, but it's probably because it is cheap and I am cheap, and that's why. But anyway, I digress. So anyway, so if you look at the yield curve, what the yield curve is telling us, well, from a standpoint of looking back the last 4 to 6 months, we've seen interest rates rising. If you remember last year, for those of you that remember me talking about bond total returns last year, most of them were negative. Why? Interest rates were rising. I think one of the few asset classes within the bond asset category was high yield bonds were up. That is junk bonds, that is garbage bonds. Everything else was down. Well, we've continued to have interest rates rising as we've started the year. Here's the question. People asking, Craig, why have interest rates been rising? Well, there's been a lot of buzz out there. You might have heard of the Federal Reserve and how they're going to raise rates because inflation just kind of appeared here towards the end of last year, which is garbage. But anyway, with anticipation of A, the Fed raising rates, but two, we've started to see some changes in the Fed's balance sheet. Let's rewind to March of 2020. That's when the pandemic began. Well, what did the Federal Reserve do? They started buying $120 billion a month in U.S. government treasuries and also U.S. government mortgage-backed securities to prop up the bond market and the interest rate market. That's a lot of cash. That's a lot of cash. Well, in October of 2021, they started to reduce their purchases. They called it the taper. They were tapering their purchases. Don't you love the terminology that they use? Well, they started cutting from 80 billion in treasuries and 40 billion in government agencies to, in November, 70 billion in treasuries and 35 billion in agencies. And in December, 60 billion. You probably see where I'm going, in 30. And then it went 40, 20, 2010. We are on March, and guess what it's going to? This is the last month the Fed is going to be purchasing, which also is having an impact on the yield curve. What it is doing, it is driven up short-term rates, okay? Short-term treasuries, and let me find my cheat sheet here. Let's see here. Nope, that's not it. See, this is another thing that you get to see how I've got all my cheat sheets on my screen behind me, so I appear very intelligent in how it just rolls off of my tongue. I'm really not. I'm cheating like a sucker, and but that's okay too, because it kind of looks cool. Anyway, we're going to talk about 2-year rates here, and gosh dang it. See, this is the thing. I get all fired up because I'm prepared, right? And then it just doesn't happen. Okay, here we go. Okay, the 10-year Treasury closed today at 1.7. That's 10-year, 1.7%. If you bought a 10-year Treasury note from the U.S. government today, they would pay you 1.7% on your money for 10 years. Wow, what a deal, right? If you look at the 2-year, the 2-year is 1.6. What's crazy? This is really crazy. Is over the last couple quarters that rose from 0.2% up to 0.6, and now we're at 0.4. No, we're at 0.6. Currently we're at 0.48. I was right. See, I questioned my knowledge there. So what you've seen is the Fed has yet to raise rates, although Fed Chairman Powell past Wednesday, already said they're raising by 0.25%, and that's coming next week. So get ready for that. It's not going to be a shocker to anybody on the show. It's like when you're watching some deal and they give you foreshadowing on the first person to get killed in the murder flick. It's not a shocker when it comes. When Jason's coming with the knife, like in the Friday the 13th, or he's the Halloween dude, you're not shocked by that one. This is kind of how this one feels. Okay, they're going to raise by 0.25 point. Big stinking deal. So anyway, I would argue that because they started tapering already, that the anticipation of rates rising, they've already made the equivalent about 5 to 6 quarter-point rate hikes already without having to do anything, because short-term rates have risen so fast. What's starting to happen now is we're seeing the middle of the yield curve from about 10 years out to 30 start to decline, okay? Remember this, when you're entering a period like we are now, which could lead to a recession. I'm going to say could because we don't know yet, but it could. There are parts of the investment world that actually are good places to be. One is gold, precious metals. 2, commodities, because they've gone up like crazy. 3, the US dollar, which we own. We also own gold. 4 is US government treasuries. Why? Fear causes money to run from the stock market into these asset classes because they are perceived as to be a safe haven, and I would argue that they still are a safe haven. Okay, so we're already seeing that happen. What's going to happen next week when they raise the Fed fund rate? I think it's already built in, and the market's going to kind of go, I mean, there's more things to worry about. You've got a reacceleration in inflation right now with oil going through the roof, which has sucked up all the commodities. 2 weeks ago, I talked about how commodities had rolled over and that most of them were declining except for butter and oil. You remember that one? Well, now that's flipped around, and I think 24 to 26 of those 32 different commodities that I watch and that I track out there are now all rising. So we're seeing inflation reaccelerate. The Fed's got its hands full, and we have this small little altercation called Russia and Ukraine, which is a travesty. It's really sad. I'm not going to spend a lot of time on that today. But anyway, lots of amazing things happening. Positionally, okay, I have been slowly positioning for this type of a situation since November. Now, the Russia gig has accelerated this process. So I wasn't quite where I wanted to be very candid with you, but we're close. If I ever get any bounces in the markets, we'll get there. But even with that, most of our accounts today were up. So think about that. Today was a crap show. I was going to say a really bad word, but with my wife and my mom watching these things, I got to really watch myself, or I could really get some crap from that. Markets were tough today. We were up in most cases. Why? Treasuries were up big time. Gold was up big time. Dollar was up big time. So we're ready. I want you to know that we're positioned very well. Okay. Wow, I'm already at the things that make you go, Someday I'm going to play that song for us in the background and we can do a little dancing. But anyway, this is interesting here. This talks about how we've had a steep drop since the pandemic of America's desire to work. This is pretty incredible. From February of 2020 through December of 2021, we saw that participation in the workforce, which normally hovers, pre-pandemic it was 63 point change, okay? It dropped 4.6% down to 59, actually just below 59%, which is crazy. There are a lot of people that lost their jobs or were misplaced from a job that have not gone back to work. And at this point in time, they're not. I find that quite interesting because it shows our labor force is a lot more fractured than what the employment data is showing here today. Lots of jobs out there. Everywhere you go, there's help wanted. There's more jobs than there are workers, which doesn't happen often, okay? Next thing that makes you go, or makes me go, a recent study showed a direct correlation between social media use and poor mental health is larger than mental health and binge drinking. Now, for those of you that remember being back in college, and I'm sure no one that's listening to this ever binge drank. You kind of have to study all week and you get to Friday night and you hammer a case. That's just what lots of college kids do. Mom, I never did that. I didn't drink a case. Maybe a 12-pack. I didn't drink a case. And I laugh at that because I know my mom's crying right now laughing, and she will give me some shit for that. And I said it and I did, but I deserved that one. Nope, I love my mom and I know she loves me. But anyway, I find it interesting how you look at kids today and how sucked in they are to TikTok is a big one, or anything on social media, and how it guides and drives their life. And that's just kind of a tough deal. And it's really sad. For those of you that have kids, watch them. For those of you that have grandkids, that's going to be a hard one. Pray for them. That's all I can say. Because the social media thing is a bad deal and it's doing a lot more harm than help. Moving on here. Lastly, one of my research analysts, Todd Jordan, I'm going to give him credit for this. He wrote a little piece where he was talking about what was going on in Ukraine right now. And he stated, I'm going to read this so I get it right because it was so good. And I'm really going to end on this because I'm already going long today. But it says, democracies don't go to war against each other. Authoritarianism starts wars. And it doesn't matter if the brand of authoritarianism comes from the right or the left. The politicians in this country use labels like right, like left, like conservative, like liberal. They all see, and then I looked up and look what happens. See, they use these terms to prove their preferred flavor of leaning that is the correct one, which I find interesting. Authoritarianism kills from both directions. Does communism kill? Well, there are millions of dead Soviet citizens, Chinese citizens, North Korean citizens, to name a few, that suggest that it does. But communism, the economic system, it doesn't kill necessarily. Rather, it kills because it leads to authoritarianism necessarily. It leads to an authoritarianism necessarily. And I'm going to close here. I'm going to get to the bottom of his read. But he closes and he says, we need to get serious about our foreign policy. And he says, I'm not a foreign policy expert. I don't have the answers. I'm a concerned citizen and educated enough to understand that we don't have a serious foreign policy to deal with Russia, China, or any other authoritative country. That is fact. Unfortunately, too many people in the U.S. have been trained to simply see either Republicans or Democrats as the enemy. And with that, I'm dropping my mic. This is Craig Modelmog for March 4th, 2022. Love you guys. Thanks for joining me. And I am out.